Have you ever applied for a credit card or a loan? If yes, then I'm sure you know how crucial a credit score is. Did you ever just monitor closely your credit score thinking, okay, just let me check my credit score to know if there are any changes? As much as a hike in score can excite you, a sudden drop can equally be alarming. Even after adhering to all guidelines, do you still see an unexpected drop in your credit score? If yes, then you're in the right place. Today, I'm going to tell you what are the actions that are often overlooked by people that leads to a sudden drop in credit score. But before we get to that, let's first understand why do credit score actually matter. Well, your credit scores determine a lot more than the loans that you can get and the interest rates that you pay. Insurers use credit scores to set premiums for auto and homeowners coverage. Landlords use them to decide who gets to rent their apartments. Credit scores determine who gets the best cell phone plans and who has to make bigger deposits to get utilities. You can leverage great scores into great deals on loans, credit cards, insurance premiums, apartments and cell phone plans, etc. However, on the other hand, bad scores can hammer you into missing out or paying more. For those unaware, credit score ranges from 300 to 900. Generally, lenders consider a credit score of 750 and above as ideal. Therefore, you should always take measures to have a credit score that is close to 900. Now let's get back to understanding why credit score falls when nothing changes. Well, the very first reason as to why credit score drops suddenly is when you apply for a new credit card. Usually, credit issuers pull your credit report when you apply for a new credit card because they want to see how much of a risk you pose before lending you a line of credit. This credit check is called as a hard inquiry or a hard pull. Now remember, whenever you make an inquiry about your score, it is called as a soft inquiry and it does not reduce your score. But when you apply for a credit card, then the lenders check your score, which thereby temporarily lowers your credit score. But hard inquiries are not always bad when they happen in moderation. After all, applying for a credit card is a great step in building credit. When you use credit cards correctly, that is by purchasing and paying them off in full by the due date, then they can help you increase your credit score ultimately. Now, to reduce the number of unnecessary hard pull on your credit report, check if you qualify for a new card by using issuer's pre-approval or pre-qualification offers. These won't actually guarantee that you will be approved for a specific card, but it will give you a good idea. The next reason is when you max out on credit card. Well, all of us avail credit cards so that we can make large purchases because we don't really need to pay the entire money upfront, right? Then how can actually purchasing things with a credit card drop your score? Well, leaving a high balance on your card will report a higher credit utilization rate to the credit bureaus. Your utilization rate or your debt to credit ratio measures how much credit you use when compared to how much is available for you to use. You want to aim for a low utilization rate because using too much of your available credit limit shows that you pose a financial risk to issuers. Experts recommend keeping your credit utilization below 30%, with some even suggesting that below 10% is ideal and is a best credit score. Now let's understand this with an example. Let's say your credit limit is 1 lakh and you make a purchase of a laptop which is worth 90,000. Then in such a case, your credit card might drop drastically. Now before you charge a hefty expense onto your credit card, make sure that you can pay it off in full before the billing cycle ends. Carrying a high balance on your credit card is not only bad for your credit utilization rate, but it will also incur a whole lot of interest. Moving on to the next reason is missed on credit card payments. Now think back on your payment history. Have you ever missed a credit card payment in the last few months? Were there any bills that you have missed in the previous months? Because your payment history is the most important factor that determines your credit score, missing a credit card payment will have an immediate negative effect on your score. Needless to say, lenders and issuers care a lot about whether you have paid your past credit accounts on time because they indicate your risk. A 30-day missed payment can drop a fair credit score anywhere from 17 to 37 points and a good or an excellent credit score to drop 63 to 83 points. But a longer, say 90-day missed payment drops the same fair score from 27 to anywhere between 47 points and drops excellent score as much as 113 to 133 points. Well, in other words, the higher your credit score, the greater the negative effect will be. How quickly your score bounces back will depend on your credit history and your payment behavior after you miss a payment. If you jump back on track quickly after, it's likely your score will start improving along with your good payment history. A history on time payment is vital to a good credit score, and it's even better if you can pay them in full. Moving on to the next reason why your credit score drops suddenly is when you paid off a loan. While paying off your credit card debt can increase your credit score, paying off installment debt such as a mortgage or a student loan has a total opposite effect. Paying off something like your car loan can actually cause your credit scores to fall because it means having one less credit account in your name. Having a mix of credit makes up to 10% of your credit score because it's important to show that you can manage different types of debt. Don't let this prevent you from paying off your debts, however. Being debt-free will help your overall financial health, and it makes no sense to pay unnecessary interest charges over time just to save a few credit score points. The next reason is when you close your credit card. While closing a credit card account, especially your oldest one, hurts your credit score because it lowers the overall credit limit available to you and it brings down the overall average age of your accounts. The length of your credit history makes up to 15% of your score, which is why experts recommend building a credit at a young age. The longer you can show you have had credit, the better for your credit score. The next reason is when there is inaccurate information on your credit report. Well, sometimes creditors make credit reporting errors. Because of this, it's a good idea to always review each of your reports. While reviewing your reports, make sure your accounts and personal information are correct. If you spot an error, for example, then dispute it with each credit bureau that lists it online by mail or phone. The next reason is the credit mix. Credit mix is the last and most important component of your credit score. It accounts for 30% of your credit score. It is determined by the type of credit line you are having and how many there are. It's a mix of installment credit and revolving credit. So, well, what is exactly installment credit and revolving credit then? Well, installment credit has a fixed amount and a fixed due date of payment, like mortgage, loans, etc. While on the other hand, revolving credit does not have specific due date or the amount to make a payment. Credit cards come under the revolving credit. While on the other hand, revolving credit does not have a specific date or the amount to make the payment. Thus, it is wise to make the minimum payment on time and charge only how much you can afford per month, not more than that. Maintaining a credit mix shows that you are able to handle various types of loans at one time without making any default. Also, it will help you in keeping your credit score healthy. So, if you have only one credit card in your account and make payments on time, that will also improve your credit score, but it will take time. Hence, it is advised that you take small amount of personal loan that will ensure that you can handle different types of credit. So, these are some of the reasons why you see a sudden drop in your credit score. But should you really worry about that? Well, changes in your credit score are completely normal. So, there's no need to worry about small fluctuations. That being said, it's good to check your credit report at least once in a month so that you can monitor these changes when occur and you can make necessary changes if you see your score go down drastically. Also, for in-depth knowledge on credit score, we have developed an exclusive course which is available only on our Freedom app. So hurry up and download Freedom app from Play Store or App Store. Also, before going, do not forget to hit on the like button, subscribe to our channel, and do not forget to hit on the bell icon to get notified for our next video. Thank you for watching IndianMoney.com. Get wise, break free.